Yeah, I mean, I would say, the patterns are really relating, it's not a black box by any means. It's more a pattern relating to corporate events. So for example, I got started in the late 90s doing risk arbitrage. And so in the early part of this year, and that business, let me go back. I started in the late 90s doing risk arbitrage. By the early part of this century, risk arbitrage was no longer sort of an attractive return business, that a lot more capital entered the business, which compressed spreads, and you had interest rates falling, which further compressed spreads. So it was not the glory days of this business were in the 80s and 90s, and they'd passed. And so most of us moved on to other event situations, spin-offs, restructurings when they came along, litigation, other balance sheet events. Well, at the beginning part of this year, there was a lot of dislocation in the market, and all of a sudden risk arbitrage spreads really widened out. This was in February. And so I started looking back at it and have put on a few positions in that area since then. And so that is really going back to patterns that I learned, 20 years ago of looking at a situation saying, okay, there's sort of a checklist. Say, well, the definitive agreement, what are the terms, what are the regulatory risks, is there a possibility of another bidder coming in, and what's the downside if the deal falls apart, what's the timeline, and things like that. And being able to make that analysis pretty quickly to say, okay, am I being appropriately compensated for the risk I'm taking? And then that allows you to put the position on quickly. And then the real work starts of, okay, now let's make sure, are there risks I didn't see at first glance, and dive deeper into that. So that would be an example of pattern recognition. It's not any, it's no black box. It's